You're listening to the Ottawa Real Estate Podcast, brought to you by Referral Mortgages and Blue Panda Realty, with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate in our nation's capital.
Good morning. Good afternoon, everyone. It's the Ottawa Real Estate Podcast. We are without Greg Campbell, so I don't have to wait for him to laugh today. Here with David Warren.
Yes, sir.
Hey, quick shout out. Just want to say before I even introduce myself, we'll say a quick shout out to our sponsor, Brew. If you go to northbrew.ca and use the promo code podcast, you'll get 20% off your order. And on every order you make, 20% of those proceeds go to help local homeless shelters. So, it's that time of year. Gets colder, gets a little harder to see, people on the streets. So if you buy some coffee, it will 20% of that's going to go to helping local homeless shelters. It is the Ottawa Real Estate Podcast. My name is Paul Stevenson. I am one of the owners of Referral Mortgages and a mortgage agent. And I'm here with David Warren, who is my business partner. He is also an owner and mortgage agent at Referral Mortgages. Greg is not with us today, unfortunately. But we do want to wish his wife a happy birthday as well, and a happy birthday. And speaking of birthdays, David, I feel like you may have some news for our listeners.
Yes. Yeah. Wow. Way to just cut right into it. No.
Rip the Band-Aid off.
Yeah. No, I was off last week. I wasn't here for last week's show, which I must say was a great show, and we'll definitely touch on a couple of those topics today. But I had the birth of my firstborn on December 2nd. Yeah. So I get to, I've joined the dad train with you and Greg.
Yeah. I was laughing saying that you might actually appreciate the dad jokes a bit more now. The mood boost. It'll grow on you. You can't help it.
I don't know about that.
You can't help it. The other thing I was kind of laughing about this morning, aside from your baby, is that you were saying you just started getting newspapers again delivered to your house. Everyone's kind of moving to that digital platform for news intake. But you're going the other way.
I'm going the other way. No, I love the newspaper. I thought, you know what? It was my first job I ever had at 7 years old of delivering newspapers. So why not continue supporting the industry? So I think I'm probably the only one in my area, and Globe and Mail is losing money on gas.
Yeah, they just have an Uber driver drop it off to your one house, on the way.
Yeah. But yeah, no, I decided over the weekend, I've been wanting to get the newspaper delivered for a while. I consume a lot of news, and I love a physical paper. So did that over the weekend. That was my big purchase. That wasn't Amazon.
I think people will probably shift potentially back that way. It's there's so much. Well, I shouldn't say. You probably get misinformation in newspaper too, but there's so much information online that it's virtually impossible to get like a true nonpartisan. Just like, here is the news. At least if you're reading it, you can kind of take your time, dissect it a bit more, and I don't know. It's definitely a different way to take in information. I've been thinking about doing it recently myself, so it's kind of hilarious that you said that. You might push me over the edge. Well,
you have a working fireplace, and you go through. You have a fire every day, so that's at anything at least is going to save you money on the kindling.
That's true.
And fire starter.
We actually I had 2 more cords. Shout out to La Cosa. Oh my gosh, did you get it right? They
dropped off when you don't know them.
Yeah. They dropped off 2 more cords on Friday, and me and the boys stacked that in the garage. So we're definitely stacked. Should last at least a week or 2 of fires. But yeah, the kindling, basically when I get flyers now, they're the only thing I have that's made of paper now. So I just, use that little kindling. So any newspapers, I'll certainly take those. That'll be fantastic.
For sure.
So in the news, so you weren't here last week. Yeah. Any reflections? Any things you wanted to add or comment on?
I thought it was a great episode. I thought, one topic that was discussed was about tax on your primary residence, kind of avoiding or taxing home flippers. I think, one thing that wasn't touched on, or that people might be misconstrued on is this is people with their primary residence. Home flipping has always been taxed at 100%. So flipping homes as a business is taxed at 100%. So like I flip homes as well on the side. This past year I've only done one, but I've done multiple, probably upwards of 6, 7 in the last few years. When claiming it on your personal taxes, it's business income. You're taxed at 100%. if you're doing it if you're doing it in a company, your company is taxed on that revenue at at that full tax rate on that revenue. So home flippers have always been taxed, and in the news, it makes it seem as though they haven't been, or that they've been able to get away with, paying only 50% of the capital gains, when that's not true. You're actually, flippers as a business is being taxed fully. It's those that are trying to say that they're moving into it, renovating and selling it off, that would be, skirting it, but they're just reporting it illegally to CRA regardless. They're not like that woman that bought it 4 years before her closing date and finally moved in, and life changes happened, and they're trying to claim it as a flip. That's not, that wouldn't constitute. But home flipping, I just wanted to kind of touch on that. Home flipping has always been taxed as a business, as business revenue, and at that full rate.
Yeah, I think the change that they're seeing now is that 12 months for primary homeowners is what they're trying to propose. And that's obviously as a deterrent to people doing that. So, if you're saying that it's going to be a primary home and you're moving into it, you obviously typically would have to sign some form of, affidavit or agreement at your lawyer stating, if the lawyer has any kind of assumption that maybe you're going to do a flip, depending on the area of the home, or if there's been a lot of flips kind of in that neighborhood recently, or, they have their finger on the pulse. So anything that kind of tips them off that maybe this won't be your primary residence, you may have to sign kind of a letter at your lawyer stating that, yes, I am going to be residing in this home, and so on. So people will sometimes just sign that letter and really have no intention of moving in. And that's, I think, what they're trying to deter by this is anyone that, is doing it for the sake of flipping and trying to skirt that tax, they're going to get kind of penalized. And then I think you're right. What happened to that woman I think it was Markham, was that they assumed that she was flipping when really she was living in the home. So,
and she didn't have any other property. She didn't own another home, converting that to a rental and moving into this one, and then just saying that, or having multiple properties. I mean, rentals as well. If you have a rental property and you sell it, that is taxed as a rental. There's there's capital gains on that as well. So if you own a home already, you buy a new build, you say you're moving into it, and you don't, well, that's, then you're misreporting it regardless of that, of that fact. But if you're buying a new build, you're buying it as a rental, that's going to be taxed as a rental. Even if you sell it within a week, within 5 years, it's still you're still paying capital gains on it. So it's really people that are, basically misreporting that they're moving into it when they're not, and they're staying in their current home. But that's a completely different issue altogether. I mean, investment properties, flips, they've always been taxed. And so, I think there is a lot of just headline grabbing and trying to just deflect the attention away from the fact that, as we keep saying, that there's the municipal, provincial, and federal red tape for building and increasing supply in the market is what's driving prices, and not home flippers. These, people that they're trying to call home flippers, like the woman that bought a place 4 years before. That's, they need to kind of just stop going for attention grabbing or headline grabbing and just focus on that core issue, which, kind of leads into as well with, where inflation's going and all of that. And I know this week, I believe it's this week, the finance minister, Christina Freeland, is going to be announcing some, how the changes in the Bank of Canada policy for increasing prime is going to be, and what she deemed as guardrails last year are going to dictate what, when Bank of Canada should make those changes. They kind of made that policy change that the federal government will have some say every 5 years as to how prime will be adjusted, and inflationary monetary policy. So it'll be interesting to see this week what those guardrails deem as. I mean, right now, unemployment rate is where it was in February of 2020, right before the pandemic, where they've said we've fully rebounded from an employment standpoint. So it'll be interesting to see whether they're in their update or budget update this week, and as well this monetary policy with the federal government.
It's been interesting over the last 2 months when, I guess end of October, when the government assistance kind of slowed, that the restaurants and everything has opened up to capacity now. Like, everyone has been able to find people in the workforce, it seems.
There's
At least
still a
locally.
huge shortage. There's definitely still a huge shortage. I mean, a lot of restaurants that I go to restaurants quite a bit and being right along Preston, a lot of restaurants can't open up capacity still because they're still limited on kitchen staff, is where the biggest is. I know one of the new steakhouses down on Elgin, Harmon's, fantastic place actually, but they aren't able to run it as high a capacity as they'd like to because of or open up longer hours because they're short on staff. And you see hiring everywhere. It's really an issue. I don't know where what's driving the lack of employment base there, but it'll be interesting to see if this week whether they announce anything of curtailing the spending, the stimulus. It's
interesting you say that because
they need to cut it back. They need to shut off that at some point.
Yeah, the reason why I went there is because you stated that the unemployment is where it was pre-pandemic, and I have at least personally noticed, like especially being just out, in malls and in restaurants as well. Like it seems like restaurants are certainly more full than they were when they first opened, a month or two ago, and that I assumed was due to being able to hire more people. Because in the beginning, even when they were full capacity, there wasn't as many people out, and obviously a part of that is kind of fear potentially by some of the public. But I also thought, speaking to people working there and so on, that there was that shortage. So if you're saying that's still an issue, then it would be interesting to know like what industries had shortages pre-pandemic and then where those shortages are now to see the variance.
Yeah, no, for sure. I think, overall, I think it'll be an interesting week, and next week our episode to finish off the year going into the Christmas break will be an interesting one because the budget update and this monetary policy change by Christina Freeland will have been released. So be a lot to talk about next week as well. But, on the topic of inflation, and I know I get a lot of emails about it from clients is, whether they should lock in their variable rate to fixed. Mm-hmm. It's always a conundrum of people whenever it's in the news constantly of rates increasing, what they should do, anything like that. Really, and I'll say my viewpoint, and, people could do their own research as well, but variable rate over the last 30 years has won out every single year except for two, where it was at a slight loss compared to fixed in comparison. Right now, you're getting variable rates at prime -1 or greater than that. Prime -1, prime -1.1, 1.15. There's over a 1% difference between the variable rates right now and fixed. So if you're in a variable rate at, let's say, prime -1, so you're paying 1.45% right now, the 5-year fix that you'd be converting to, or even 4-year fix, if you're 4 years remaining, with a variable rate mortgage, you could convert to a fixed rate at any point without any penalty. You cannot do it the other way. You can't convert from a fixed to a variable. Banks like you to lock into a fixed because they can hit you with huge penalties when you go on break, because the statistics are 66% of people in Canada don't make it to the end of their 5-year term, whether it's a breakdown of a relationship, it's selling a home, refinancing to pay down debt, or pull out equity to, do an addition, or to buy a truck, or, whatever it may be, pay for schooling for a kid, adding a HELOC. These things all contribute towards breaking your mortgage. And 2/3 of people in Canada do that within the first 5 years, or sell and walk away. Banks like you to be in a fix because you pay the greater of a 3-month interest or interest rate differential, or IRD penalty, which is how much time, looking at where your rate is, current rates on the market, how much time you have left in your mortgage, how much interest the bank is losing. And it's a convoluted calculation of the interest being lost. And they pass that back to you. On a variable rate mortgage, it's 3 months interest is the most you'll ever pay as a penalty. So the banks really do only typically market fixed rates because they want you in that, because they know they're not out for your best interest, they're out for their shareholders' best interest, and they want to lock you into that fixed rate to get the penalties. Converting from a fixed to a variable to a fixed, right now it's over a 1% difference between the variable and the fixed. Whenever the Bank of Canada has historically increased bank prime, it's at a quarter point at a time. They increase, they wait, a couple months, even a quarter, to see how the economy handles it before making another increase. Effectively you would need right now, the spread between variable and fixed is an average of 1% to just, around 1.25%, meaning you would need 4 to 5 increases by the Bank of Canada to equal what that fixed rate would be. And then you would need subsequent increases to then be at a supposed loss. Now, the entire time that you've been paying drastically less in rate, you've been saving on your monthly payments, you've been paying off that much more principal, and you've been saving on interest. There's always 3 components to your mortgage payment. Why would you go from 1.45 and make that conscious decision? I'm going to lock in at 2.79. Why would you almost double your rate voluntarily? You're increasing your payments dramatically, immediately. You're paying that much more in interest and that much less in principal. It's costing you thousands and thousands of dollars. At the end of that as well, you also have a huge penalty if you were to break. By your mortgage today, that balance is much larger than it's going to be whenever the rates, if prime goes up 4 times, it's going to be at a lesser rate. Your balance is going to be lesser in the future. So your interest being calculated is on a lesser balance as well. You never know what's going to happen with the economy as well. We've got, talks of Omicron, if that ever goes anywhere. We've got Evergrande, which defaulted on their bond payments over in China, $30 billion. I think it's $3 billion in bonds, but they've defaulted. The credit rating agencies have reported that. What that ripple effect of that $300 billion in Evergrande debt is going to do with the economy. You never really know. So voluntarily jumping your payments before Bank of Canada even has an opportunity to do that, to me doesn't seem worthwhile for the cost associated. Really, if you look, I think the best trend is looking historically at 2008, coming out of the housing crisis there. It took them, if you look at that historic trend, it was once a quarter that they were increasing, and to increase it by 1% took them, I believe it was 2 years to increase that 1%, which you would then equal, and then you've got to increase it again further. So, it's best to, in my opinion, it's best to stay the course on variable, take advantage of those lower payments. You can also then, if you want or you're afraid of those higher payments and being saddled with them when prime goes up, well, switching to fixed is going to increase those payments anyway. So what you could do is leave your payment, your rate as a variable, and voluntarily increase your payments now. So figure out what the payment would be based on 2.79%, let's say. That's a going fixed rate on a conventional mortgage right now. Set your payment, even though you're 1.45, set your payment as if it's at 2.79. Increase your payment voluntarily. You're going to pay off. You're going to be paying what it's going to be if it goes up to that, and you're going to be hammering down your principal, saving a heck of a lot of interest. And then when prime does increase, you can then reduce your payment back, and you're not going to notice any hit. But the thought of locking in and voluntarily saddling yourself with that huge increase of payments and higher interest is doesn't really seem to make too much sense to do so. And really, it's just that historical trend that's best to look at. I don't know if Paul, I know that I went on a little ramble there, or tangent, but I know you get
I'm still here, everyone. I am still here.
I know you get emails all the time about it.
Yeah, I had an actual, questions about that all the time. I think there's also some confusion that most people think, like they may know that their variable rate's convertible, but I think their assumption is, and oftentimes we have to clarify this when we're going through the commitment part of it, like kind of here's the solution, you're on variable, here are all the ins and outs. We have to explain to people that the convertible rate is not the rate that you're currently at on your variable. Like people think if they're at 1.45 variable and it goes up to 1.7 and they convert it to fixed, that they're going to get a fixed rate of 1.7. It's not the case, right? You're going to have to get whatever the rate is that lender is offering at that time based on what you have left in your term. So as you said, Dave, like if you have 3 years left, you're subject to the 3-year rate, excuse me. So typically your rate's going to go up, like you said, like maybe a 1% or even a 1.25%. And you're doing that to avoid the potential increase of 0.25% or 0.5%. So you're voluntarily increasing it by 5 times what you're worried about happening once, so or twice, So there is talk, there's a lot of headline, saying, prime might go up to 11 times or, like basically 2.25, 3.25%. Like that's, 2.75%. Like that, in my opinion, would be crazy. Like if prime's sitting at 4% in the next year, that would mean wreak havoc on the whole economy. But I did do a calculation recently for someone who was debating kind of between that fixed and variable, which is a very common question. And based on, they were putting 15% down. So the rates were better than most. But we are comparing the fixed rate of 2.44. This is about 10 days ago. So the rates have climbed a bit more since then, but 2.44 over 5 years versus 1.15% variable. And just on that difference of fixed and variable, their monthly payment savings. So just in monthly payments themselves, they were saving over $20,000 in 5 years. And then the interest savings was an additional $42,000 based on their loan amount. It's a larger mortgage, but that means they're essentially starting with a $60,000 buffer by not going fixed. So it's like, how important is that peace of mind to you? Which really, to me, like the risk is the rate risk. Like the risk is that the rates may go up, but like how much is that worth to you? Is that worth $60,000 to have that peace of mind? And like you said, Dave, like my advice is just will voluntarily increase your payments by that $300 or $400. If you're worried about it, you're going to pay that anyways if you go fixed. So just voluntarily pay that. And at least that's going to your principal and not to interest, and you have a even further head start if rates do increase. Yeah.
It's an interesting conversation. And it's always a debate. I was, it's always, providing to clients the differences between fixed and variable. It is a personal preference. Like you said, it is peace of mind for some people. Thinking about having to think, or even, going into a property or going in, buying a property and that they kind of have that mental block of not wanting to think about or have it on their mind of, what's Bank of Canada doing with prime, and how is that going to affect my payments? Again, solution, increase your payments. Don't think about it. I know that's easier to say than not, but historically there's a reason why the banks push fixed and they only market fixed is because of the large penalties and they make more money off it. It is not because it's in the best interest of the Canadian public.
Banks are companies and they're trying to make profit. I mean, that is like the people that are lending you the money are obviously in it because it makes them money to lend you money. So, I mean, it's like anything, you have to kind of take a step back and think about who's giving you the information and do they have a benefit in giving you that information? If they do, ask a few more questions, and the variable rate, in that case, I was just talking about, there was a $400 a month, $420 a month difference in payments. So when you think, okay, 244, still a very good rate, which it is historically, but the difference between 1.15 and 244, it's like, oh yeah, okay, well, it seems like a pretty big difference. If you're talking $400 a month, like that's a really large savings monthly. You're talking $5,000 a year. That's not chump change. Like that's a lot of money that you're giving away for that perceived peace of mind. So it's really like, ask yourself the question, if you want to go fixed, and there's nothing wrong with it. I'm just saying, if you want to go fixed, why are you choosing that? And just make sure that you understand what you're basically giving up as far as cash and interest savings by taking that option. And, especially if you're going the route of speaking to your bank and going into the branch, ask your advisor that question, because they may not know those calculations, and worthwhile having them break that down for you. Like the same way I did for that client, just ask them, like, can you show me the difference between the fixed and variable over 5 years, between payments, interest, principal pay down? What's my balance even after the 5 years? Because those are all different. And it's really important to know those numbers before, this is a huge purchase you're making. So you want to be well informed and you want to be making the decision that's right for you and your family, as opposed to, like you said, Dave, just being sold that peace of mind, maybe unwarrantingly. And again, we're not like pushing variable, but this is obviously, we're both very large proponents of variable. And
I'm pushing variable. I'm pushing variable. I'll say it. I'm pushing variable.
If someone asks me what I think, I suggest variable, and this is what I explain to them, because really to me, it's a no brainer, but we also see it every day. So it's a lot more, it's easy for us to say it's a no brainer because we see the numbers, we've run the numbers, we've done these calculations for 9+ years, and it's the proof is in the pudding.
There's one thing as well with variable that people we touched on is people are worried about their payments going up, when Bank of Canada changes prime. So with a variable rate mortgage, of course your rate is variable. So if Bank of Canada increases prime or decreases, like they did during the pandemic, your rate will fluctuate. And with most of the banks, your payments will increase or decrease accordingly as well. There are some banks that your payment is fixed. So your payment on closing will not change if variable changes. It's locked in. So if your concern is a fluctuating payment and budgeting, which is everyone, no matter of your situation, should be mindful of, and budgeting, and accordingly is very important. You can still get with a major bank, a variable rate mortgage where the payment is locked in. If prime goes up, your payment does not change. Now, what happens is the amount within that payment, the amount that's going to interest and the amount that's going to principal will change, and that will fluctuate. So if it is something where it's from a budget and from a locking in the payment, that's your most important. And it's not actually the rate side of it. It's just locking the payment. Speak to Paul or I. We can provide you guidance as to what lenders do this. And as well, for those of you that are buying investment properties, you really do not look at the fixed rate. Look at variable. The percentage of people with investment properties that break their mortgage before the end of the 5 years is even higher than that 2/3, because you're not residing in it. Another investment opportunity comes up, something changes in your life where you're liquidating or you're refinancing, maybe tapping into equity to buy another investment property or to pay off some personal debt or to use it to do something in your primary residence. You have a higher propensity to do something with an investment properties mortgage than your primary residence as well. Going into a variable is your best bet. Again, a lot of investors want to gravitate towards fixed in a lot of cases because of the stability of payment. Again, speak to Paul or I. We can guide you as to which banks on a variable will be a locked-in rate or locked-in payment rather, to give you that peace of mind of payment stability, but as well as having that flexibility of the 3 months interest penalty, the lower rate, delta, et cetera. I don't know if you have anything to chime in on or add to that.
I could go on about variable rates for a long time. I'm a huge proponent of variable, and I've taken variable my last 3 mortgages, and every single time I've been very, very happy that I did because, rates have stayed low for obviously quite some time now. I did want to say on that note, David, you mentioned for people to reach out. We are available. I know, oftentimes, people talk to me having listened to the show and they're just like, oh my gosh, we hear you on the show and we just assumed that, you weren't still talking to clients, given the fact that, we do have the brokerage with agents and so on, but we are still active agents and I'm always open to those conversations, as I know you are, David. So, if you're a client listening to this or you're a homeowner, or even a mortgage agent, realtor, you have questions. I mean, we're open. Our phone numbers are actually in the description. Our emails are in the description. Maybe the phone numbers aren't, but emails certainly are. So definitely reach out. And, we love not only talking here, but we like talking to people as well about real estate. So if any of these things kind of pique your interest or you want to get further clarity, by all means, reach out anytime. And we're more than happy to hop on a call or video call, or we'll get you on the show even, we'll have a guest. So I maybe if I'm throwing Stephen for a curveball here, but maybe you can bring this up. Before we jump off the variable versus fixed, I just want to illustrate or show that this isn't just our own opinion of variable being outperforming fixed. So this is a chart, and we'll post it in the notes as well on the YouTube video. This is since 1975. The trend of fixed versus variable. Variable has outperformed since 1975 till 2021 every year except for 4. Sorry, I said 2 in the last 30 years. It's since in the last 40 years, almost 40 years, it's been it's outperformed every year except for 4. So scroll through this. This isn't just Paul and I's opinion on variable versus fixed, but you can certainly see scrolling through of what where those are at and kind of how they've performed on that. So there's a lot of do your own research. We always say
speak to multiple professionals in the space and do your research on them. But no, there's a lot of content out there and a lot of information and historical information on the differences between fixed and variable. So I'll leave it at that. I won't keep going off on it, but yeah.
Numbers don't lie. Numbers usually tell the story.
Yeah. Well, Paul, should we jump into the mood boost?
I would love that. Yep. I have 4 today, and these are coming again from my aunt. I got a few more on that Rolodex, and they're pretty good. Number 1, you guys might not know this, but I once worked at a cheap pizza shop to get by. I needed the dough.
Okay.
See, everyone, Dave got a little chuckle there. It's the dad in him now. He's chuckling. Number 2, my friends and I have named our new band Duvet. It's a cover band.
Okay. Mm-hmm.
Number 3, I lost my girlfriend's audiobook, and now I'll never hear the end of it.
Wow.
And last but not least, why is it unwise to share your secrets with a clock? Well, time will tell. Time will tell.
Okay.
Wordplay.
All right.
Wordplay.
Those are something.
Yeah. I do want to say we everyone who's listening that is in the mortgage industry. If you're a new agent, thank you for listening. If you're an existing agent, thank you for listening. But if you're a new agent, go visit the OntarioMortgageAcademy.com. This is an academy that Dave and I are both very close to and connected with. And it's basically a free course for new or newer agents. So as long as you are a licensed agent or have registered for your mortgage license, this is a course that will basically give you, it's 4 weeks, 1.5 hour a week. And it basically breaks down all the ins and outs of how to run a successful mortgage business. We're both facilitators. So we talk about, everything literally from getting a lead, to working with realtors, to, advising your clients, how to submit your file, everything basically that you're not taught in the licensing course. So there is another course starting January 12th. And I think there's 5 seats left. So if you're interested, I know we've had a few people that listen to the show that have registered, which is why I'm bringing this up. So if you're interested in that, register quickly because the seats do fill up fast. We've done 2. They've both been great success and have both been sold out also. So,
and they are free. There's no gimmicks, no hidden anything. We just want to educate the industry and newer agents where there's a lot of education lacking, and they're not maybe necessarily getting it from their brokerage or what have you, or like Paul said, the courses to get licensed don't teach you how to read a credit bureau or questions you should be asking your clients, things like that. So we're here to better the industry, and so please, if you are newer or new or just registered for your licensing course, please go to, like Paul said, Ontario Mortgage Academy. We'd be happy to have you on, and then I think starting January, and then the next, and we basically we'll cycle a new one, and I think it's February or what have you. So if you miss out on the January one, then we'll open up the seats for February as well. So
yeah, there's going to be some new courses coming out too, so keep an eye on there if you are an existing agent. Either way. So last but not least, go buy some coffee. Northbrew.ca, promo code podcast, 20% off your coffee order. And again, 20% of the proceeds go to local homeless shelters. Next week is going to be our last episode of 2021, which is crazy to even think about or say. But we are mid-December. Christmas is coming. Holidays are here. One more show, and then we'll be back in January. Yeah, mind-blowing.
12 days.
Yeah. Better start shopping. I need to.
When you're listening to this, it'll be 11 days. When you're listening to this, it'll be 11 days.
Yeah.
I gotta do some shopping.
Wow, we're within the 12 days of Christmas at this point. So get out, get shopping, stay safe, drive safe. We'll be back next week with Greg. We'll finish the year strong. Thank you, everyone. Have a good day.
Deuces.
The Ottawa Real Estate Podcast is brought to you by Referral Mortgages, Blue Panda Realty, and Stephen Hopkins Video. Thanks for tuning in, and please remember to like, comment, share, and most importantly, subscribe. We'd love to hear from you.